Welcome back to Yuri's Box. In this video I'll be talking about TLT, the week ahead. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So arguably there are two things you really want to pay attention to in the week coming up. First things first, what happened on Friday, and that is the Moody's downgrade on the credit rating of U.S. Treasuries, basically. And the two examples I can give you are 2023, where basically that happened around the summertime, about right here, if I'm not mistaken, in July. And you basically had a scenario where the downgrade came and Treasuries dropped, but then you had a significant rally after that. Now, again, there were different things going on during this time frame, well aware of that. But the moral of the story is that by the time, everything was said and done, bonds were exactly where they were in July of 2023. All right. I would keep this scenario in mind. Scenario number two is what we saw in 2011. Where basically you just had, treasuries go on a tear. Now, the reason why I'm a little bit more skeptical, I've listened to a lot of people, as many as I could, really. But again, the reason why I'm a little bit skeptical that we might see something like this play out, like, the 2011 example, is basically that 2011 was the heart of the Eurozone crisis, debt crisis. You had, contagion fears. I remember I was quite young back then. I still wasn't trading, but I was old enough to remember the PIGS acronym. Portugal, Ireland, Greece, Spain, and the idea was that everybody was asking who's next, right? Who's next to fail? Who's next gonna default possibly? And so potentially, the long end of the curve acted as you'd expect it to act, like a safe haven asset. We're not really in that kind of a scenario right now. I mean, Europe does certainly have its faults and its problems, but if you pointed a gun to my head and asked me what do you think is more similar to today, the 2023 scenario or the 2011, I would probably choose the 2023 analogy, simply because what we had in 2011 we don't really have right now. Could things change? Absolutely. But if we were to see a big move in treasuries, it would also feed into the idea of us sweeping the previous low, and that actually acting as a potential spring to break out to the upside. Of course, it could just simply just puke below. Of course, that could also happen. But if TLT goes to 65 or something like that, then I do believe that we have bigger fish to fry at that point. So it'll be interesting to see how things evolve, how we open tomorrow. I would not totally discount the idea of a news failure. So again, credit, U.S. debt gets its rating cut down. Your basic expectation is to see a TLT suffer. It would be interesting if we actually saw TLT act in a positive manner. Who knows? I wouldn't leave the possibility of I wouldn't take the possibility of a news failure off the table just yet. So again, first things first, let's see how things react to the Moody's downgrade. Second, next week is a big week. Our beloved PMIs come out, and even here, I'm quite curious to see how we print. Now, we do have some consensus estimates. Manufacturing is expected to dip barely below contraction at 49.9. Services is basically expected to stay flat. I could see this going either direction. I could see the PMIs printing at or above consensus, simply because what happened in May? Well, we took the worst case scenario off the table, meaning we went from a total embargo against China to 30% tariffs. Now, again, I've said this before, are 30% tariffs good? Absolutely not. But are they better than 150% tariffs on China? Absolutely yes. So the mere fact that you took the worst case scenario off the table could actually feel some kind of optimism. So I could see the PMIs actually printing a little bit higher. At the same time, I could easily see them printing at or below consensus, simply because 30% tariffs, aren't great news. And again, I do believe that we're kind of, ignoring this at our own peril. What we really got out of this was a tax hike, plain and simple. We have 10% on the rest of the world, 30% on China. That is a tax hike, all right? And whenever you hike taxes on something, you are punishing anybody that interacts or behaves in that certain manner. Meaning, in this case, you're punishing trade. And what I'm trying to say, that isn't great for growth, okay? So I'll be very curious to see where we print with the PMIs. They could easily swing in either direction, all right? And again, the way I use the PMIs, if you've watched my previous videos, is kind of get a rough idea of where the non-farm payrolls will print the next month. Now, I've been, if you count revisions, I've gotten close counting revisions. We also get, while we're at it, initial jobless claims. I use that for the unemployment rate on the non-farm payrolls report. So again, PMIs, they could easily swing in either direction, really. And we'll have to really assess, where they come out on Thursday. And where would that leave TLT? Well, I do believe that we are in a good news is good news and bad news is bad news environment. Meaning, if we were to see data point to the downside, I would expect bonds to take that positively. If we see good news, meaning the PMIs shoot up to the upside, I would not expect that to be good news for bonds. All right. And that is really pretty much it. Next week is really quite a quiet week. We get a lot of Fed speak. But apart from that, the highlight of the week is really the PMIs. Now, just before I close, just a quick note on initial jobless claims. We are still, hovering around the 230 mark. And again, the way I use initial jobless claims, again, as I said before, they really act as a proxy to where we might see the unemployment rate go. If you see initial jobless claims below 215, you could easily expect, in my opinion, unemployment rate to tick lower in the following report. If you see anything above 220, expect the unemployment rate to move up. And currently, we've shot up to 241 and retraced to 229. And the next estimate is for 234. It would be interesting to see initial jobless claims continue to hover around this point. And if we do, that would actually continue to make the case for a small uptick in the unemployment rate for the month of May. We could easily just, plummet back below at 220. Initial jobless claims does have the habit of doing that. But my base case, ever since I started making videos, is that we are just really repeating what we saw last year. All right, we bottom in January, and then we grind higher as we approach the summer. We bottom in January, and we grind higher as we approach the summertime. So keep an eye on initial jobless claims and continuing claims. Continuing claims, the way I usually US continuing claims, I can't remember the acronym right here. The way you can use initial continuing claims really is just as a proxy of how easy it is to get a job, all right, if you actually lose your job. So the best way really is to put it in relation, if you wanted to, with the job openings. Again, if you have lower job openings, the hiring rate is kind of in the dumps, you would expect continuing claims to, at the very least, grind higher, or again, at the very least, not drop. And that is exactly what we've been seeing in continuing claims. It does seem to me that we're poised for some kind of an outbreak or breakout here on continuing claims, potentially hitting the 2 million mark this summer. But we will see about that. So again, that's pretty much it for TLT. Keep an eye on tomorrow, how we open. If we actually have some kind of news failure on that Moody's downgrade, and I would generally fade the 2011 example and favor something more similar to 2023, where we might have some gyration, some volatility, but at the end of the day, it will be other factors that will determine the fate of TLT. And of course, keep an eye on the PMIs on Thursday. If you like this kind of content, consider leaving a like and subscribing to the channel, and I'll see you next time. Bye.